about the real reason why. For a brief moment, it looked like silver completely collapsed as prices slammed lower and panic spread fast. Traders rushed to sell and social media screamed that the rally was over. But the truth most people missed is that this crash was not real weakness. It was a setup. If you understand what actually happened in the last 48 hours, you'll realize why this moment could define the entire year ahead. Before we go further, this is exactly the kind of move we break down on War Economy Mysteries without hype or noise. Most people find this channel after the move is already finished. Subscribers see it forming before it happens. In the final days of the year, the biggest banks in the world went into emergency mode. Not because silver is weak or demand vanished. Heavy selling hit the paper silver market for nearly 2 days straight, forcing prices sharply lower into the low 70s. On the surface, it looked like a brutal crash as stops were triggered and weak hands were shaken out. Fear did exactly what it was designed to do. Then something strange happened. The selling suddenly stopped with no follow-through at all. There was no waterfall lower, no collapse, just silence. Quietly, silver began to climb right back up. That alone tells us this was never a real breakdown. When a market truly collapses, it doesn't bounce cleanly or stabilize quickly. It doesn't attract buyers instantly at the lows. But this move did exactly that, because underneath the drop was a wall, a level where massive buyers were already waiting. The moment price hit that zone, selling pressure didn't slow down, it evaporated. That tells us this level is being defended by real money, not short-term traders. These are industrial buyers and sovereign entities that don't speculate, they accumulate. And when they buy, they don't sell it back. By forcing prices lower, banks thought they were regaining control of the market. Instead, they made silver cheaper for the very players draining global supply. They handed discounted metal to the strongest hands in the market. That is a fatal mistake for anyone betting against price. Strong hands don't panic or flip positions. They remove supply from the system. And once supply disappears, price doesn't ask permission to rise. This is where the story truly changes. This entire move had a deadline tied to the end of the calendar year. Every December, the world's largest banks face regulatory balance sheet snapshots. Their risk exposure is scored, and if it's too high, they face massive capital penalties the following year. So they sell assets and reduce exposure, not by choice, but by force. This wasn't a market decision. It was an accounting decision. Once the calendar flips, that pressure disappears instantly. That's why the selling was intense, but temporary. It was never meant to last, and the market knew it. You can see it clearly in the price action and the sharp rejection from the lows. Buyers stepped in calmly, without panic or emotion. This wasn't FOMO buying or speculation. This was value accumulation by entities that think long-term. While New York was panicking, something even more important was happening overseas. In Asia, silver never truly got cheap, even during the drop. Prices there remained several dollars higher than in the US market. That gap matters more than any headline. When physical metal trades at a premium elsewhere, arbitrage forces supply to move. Metal flows from where it's cheap to where it's needed. And right now, that volatility in paper markets delays the signal that scarcity is real. That delay encourages continued overuse of futures as a substitute for physical ownership. And when the signal finally breaks through, the adjustment is sharper than it would have been otherwise. Not because demand suddenly exploded, but because supply had been quietly locked away for years. As silver continues moving east and into long-term reserves, the West faces a choice it has not yet fully confronted. Compete on price and availability, or accept reduced access. Competing means higher prices, long-term contracts, and a willingness to prioritize physical security over short-term cost efficiency. Accepting reduced access means slower innovation, higher production risk, and growing dependence on external supply chains that are increasingly politicized. Neither option is comfortable, which is why denial persists. It's easier to believe that price action is temporary, that markets will normalize, that inventories will reappear when needed. But normalization requires surplus, and surplus requires years of investment, stable permitting, and predictable demand signals. None of those conditions exist today at the scale required. Even new supply, when it comes online, is often pre-sold, hedged, or absorbed by the same long-term buyers who are already building reserves. This is why the silver story isn't about a single spike or a single shortage. It's about a gradual transition from abundance to allocation, from markets that clear through price to systems that ration through access, from speculative narratives to operational realities. Once a market crosses that threshold, behavior changes faster than production can respond. In that environment, the most important movements are the quiet ones, the contracts that don't make headlines, the shipments that bypass exchanges, the inventory decisions made in boardrooms rather than trading floors. These are the forces reshaping the market, not the daily candles on a chart. And they don't reverse just because price goes down for a week or month. By the time the broader public recognizes what's happening, silver will already be embedded where it's needed most, and unavailable where it's merely wanted. At that point, the conversation won't be about whether the price is too high. It will be about whether supply can be secured at all. And history suggests that once markets reach that stage, the adjustment is not subtle. At this stage, the silver market is being driven less by speculation and more by fear of interruption. Not fear in the emotional sense, but institutional fear, the kind that shows up in procurement policies, reserve mandates, and long-term planning models. Once industries begin modeling scenarios where silver is simply unavailable at any price, their behavior shifts permanently. They stop asking, what is the cheapest way to source metal? And start asking, what is the safest way to guarantee continuity? That question has only one answer: ownership and control. This is where traditional market logic completely breaks down. Classical economics assumes substitutes, flexibility, and demand destruction at higher prices. But silver has very few true substitutes, and most of them fail at scale or efficiency. You can redesign components, reduce usage marginally, or optimize recycling, but none of those solutions replace primary supply fast enough to matter. Recycling itself depends on past abundance, and much of that silver is already dispersed in products that won't return to the market for decades. So when demand tightens, it doesn't disappear, it competes. Competition for a scarce input does not behave like consumer demand. Consumers can delay purchases. Factories cannot delay production indefinitely. Governments cannot delay defense readiness. Infrastructure projects cannot pause without cascading costs. So higher prices do not eliminate demand. They simply determine who gets priority. And increasingly, priority is being decided long before metal ever touches an exchange. This creates a silent hierarchy in the market. Those with long-term contracts, political leverage, or strategic reserves operate in a different reality than those relying on spot availability. On paper, everyone sees the same price. In practice, not everyone has access. Some buyers pay premiums that never appear on charts. Others accept delayed delivery without complaint because they still have buffer stock. And some are quietly shut out, forced to redesign products or reduce output without ever admitting that silver was the constraint. The financial system struggles to process this reality because it was built on abstraction. Futures, options, ETFs, all designed to provide exposure without possession. That abstraction only works when the underlying asset is plentiful enough that delivery is a formality. When delivery becomes strategic, abstraction becomes dangerous. Claims multiply faster than metal, and the gap between what exists on balance sheets and what exists in vaults widens. This is why confidence is the real currency now. Not confidence in price stability, but confidence in settlement. The moment participants begin doubting whether paper claims can be reliably converted into metal, behavior changes rapidly. They shorten time horizons. They move off exchanges. They demand clauses that guarantee physical allocation. Each defensive move reduces liquidity further, making the system more fragile, not less. What makes this especially unstable is that the transition is nonlinear. For a long time, nothing appears wrong. Deliveries still happen, prices still trade, analysts still publish reports explaining why shortages are exaggerated. Then, suddenly, a small disruption exposes how tight the system has become. A shipping delay, a refinery outage, a surge in industrial orders, and what would once have been absorbed by surplus now triggers a scramble. In that moment, price becomes almost irrelevant. And the question is not how much does it cost, but who already has it. Those who prepared early look calm. Those who didn't look irrational. From the outside, it appears like panic. From the inside, it's simply the consequence of delayed recognition. The flow of silver toward regions that prioritize stockpiling over trading accelerates this process. Metal that enters long-term reserves does not cycle back through the market. It is effectively removed from price discovery. That makes remaining supply more sensitive to shocks. Every additional ounce locked away increases the leverage of the next disruption. And because this locking happens quietly, most models fail to account for it until it's too late. This is also why official reassurances often miss the mark. Statements about adequate supply are based on production numbers and visible inventories, not on availability under stress. But availability is conditional. It depends on willingness to sell, logistical capacity, political alignment, and contractual priority. When those conditions tighten simultaneously, supply can vanish without mines shutting down. In that environment, the idea that markets will naturally rebalance becomes optimistic at best. Rebalancing requires time. Time to invest, time to build, time to permit and refine. But the demand for silver is happening now, embedded in technologies and policies already in motion. Energy transitions, electrification, defense expansion, these are not optional programs that can be paused easily. They are commitments already made. So the market adapts the only way it can, by shifting from open exchange to controlled allocation, from visibility to opacity, from price-led signals to security-led behavior. This is not a temporary phase. It is a structural change. And once markets cross into this mode, returning to the old system requires a surplus so large that confidence is restored for years. That kind of surplus is nowhere in sight. What we are witnessing is not the end of the silver market, but the end of its old assumptions. The assumption that price weakness equals oversupply. The assumption that inventory is waste. The assumption that paper claims are interchangeable with metal. Those beliefs were products of a different era, an era of slack, not strain. Now the system is tightening quietly, relentlessly, and the most important signals are not found in headlines or daily charts, but in where silver stops moving once it arrives. When metal stops circulating, markets stop behaving normally. By the time that becomes obvious to everyone, the transition is already complete. As this tightening continues, the market enters a phase where reactions are driven by anticipation rather than events. Participants no longer wait for shortages to appear before acting. They move based on the expectation that access will worsen. This forward-looking behavior pulls future demand into the present, compressing years of buying into shorter time frames. On paper, it looks like sudden surges. In reality, it's delayed action finally catching up with risk. This anticipation effect is especially powerful in silver because supply cannot respond quickly. Mining is slow, capital-intensive, and increasingly constrained by regulation, energy costs, and declining ore grades. Even when prices rise, production does not surge overnight. Most silver is produced as a byproduct of other metals. Quiet, the charts look calm, and the headlines feel boring. But behind that silence, a decision has already been made by the largest pools of money on Earth. Once that decision fully hits the market, there will be no warning, no countdown, and no second chance to prepare. Most people believe nothing important happens during the holidays. They think markets slow down, money sleeps, and January is still far away. That belief is exactly why this moment is so dangerous. While retail investors are distracted, institutions are positioning quietly, methodically, and without emotion. Before we go any further, understand this clearly. If you want to know how real power moves money and how financial wars are fought without weapons, this channel exists for you. This channel is about seeing what others miss. Subscribe now because what's coming next is not normal, and most people will only understand it after it's already over. Here's the uncomfortable truth. Markets don't collapse when everyone is scared. They collapse when everyone feels safe. Calm is not stability. Calm is preparation. Right now, we are standing in one of the most deceptive moments of the year. Liquidity is thin, senior traders are away, and decision makers are not at their desks. This creates a fragile environment where even small actions can trigger massive consequences. Prices no longer move smoothly. They jump, they gap, and they shock. And this is happening just days before one of the most powerful forces in global finance activates, January. January is not just a new month. It is a reset. It is the moment when institutional money is forced to move. Pension funds, asset managers, and sovereign portfolios must rebalance. They must justify their performance. They must explain why they owned what they owned and why they missed what they missed. Now ask yourself this question. What asset embarrassed more fund managers this year than silver? Silver didn't quietly rise. It broke expectations and crossed psychological levels that were supposed to be impossible. Every dollar higher creates pressure. Not emotional pressure, but career pressure. Imagine managing billions of dollars for retirees. Imagine sitting in front of your board explaining why you owned assets that failed to protect against inflation while silver surged without you. That is how people lose jobs. That is how the rest of the industry follows. And that is already happening. Ford, General Motors, Toyota, Volkswagen, they are all moving toward 48-volt systems because the economics are too powerful to ignore. Tesla even shared technical guidance to accelerate adoption. This isn't optional. This is a structural shift. And now we reach the part Wall Street absolutely does not want to model. There are roughly 90 million vehicles produced globally every year. As this transition spreads, tens of millions of cars will require more silver per vehicle than ever before. Not for decoration, not for luxury, for basic functionality. Historically, gasoline cars use small amounts of silver. Electric vehicles already use more. But 48-volt architectures push that requirement higher. Even conservative estimates suggest each vehicle could add significant new silver demand through relays, connectors, redundancy systems, and safety circuits. Multiply small amounts by massive volume. And suddenly, you're talking about tens of millions of ounces of silver per year. This demand is not speculative. It is not cyclical. It is locked in by physics, and it arrives at the worst possible time. Silver supply is not flexible. Most silver is not mined on purpose. It comes as a byproduct of mining other metals like copper, zinc, and lead. That means silver supply depends on base metal economics, not silver prices. If silver rises but zinc falls, silver production can actually drop. Mining grades are declining, costs are rising. Exploration budgets were slashed for years. New mines take over a decade to build. There is no switch to flip. And then there's geography. The largest silver producer in the world is Mexico. Political pressure, nationalism, permitting restrictions, and labor issues are already tightening supply. At the same time, the rest of the industry follows, and that is already happening. Ford, General Motors, Toyota, Volkswagen, they are all moving toward 48-volt systems because the economics are too powerful to ignore. Tesla even shared technical guidance to accelerate adoption. This isn't optional. This is a structural shift. And now we reach the part Wall Street absolutely does not want to model. There are roughly 90 million vehicles produced globally every year. As this transition spreads, tens of millions of cars will require more silver per vehicle than ever before. Not for decoration, not for luxury, for basic functionality. Historically, gasoline cars use small amounts of silver. Electric vehicles already use more. But 48-volt architectures push that requirement higher. Even conservative estimates suggest each vehicle could add significant new silver demand through relays, connectors, redundancy systems, and safety circuits. Multiply small amounts by massive volume. And suddenly, you're talking about tens of millions of ounces of silver per year. This demand is not speculative, it is not cyclical, it is locked in by physics, and it arrives at the worst possible time. Silver supply is not flexible. Most silver is not mined on purpose. It comes as a byproduct of mining other metals like copper, zinc, and lead. That means silver supply depends on base metal economics, not silver prices. If silver rises but zinc falls, silver production can actually drop. Mining grades are declining, costs are rising. Exploration budgets were slashed for years. New mines take over a decade to build. There is no switch to flip. And then there's geography. The largest silver producer in the world is Mexico. Political pressure, nationalism, permitting restrictions, and labor issues are already tightening supply. At the same time, refiners far more than price. Paying a little extra is nothing compared to halting an entire production line. Western investors often get confused by this. For decades, New York controlled silver pricing because it traded the most volume. Most of that volume was paper. Futures and contracts, stacked on top of contracts, dominated the market. Shanghai trades something different. It trades physical silver. When markets have extra supply, paper controls the price. When there's a shortage, physical silver controls everything. We are now in a shortage market. That means U.S. silver prices don't reflect true value. Any discount in the West creates an escape route. Traders take delivery in the West, ship it east, and instantly reprice it higher. Western vaults keep losing inventory. Why would a miner sell for $70 in the West when buyers in Asia pay more? Metal always flows to the highest bid. Right now, that's in the East. Western exchanges rely on old vault inventory. Once it's gone, the system can only raise prices or fail to deliver. This is why prices keep rising even when banks try